Hello, I'm Juliet Sarli. In this week's edition of IG Macro Intelligence, we take a look at the investing outlook for AI-related stocks amid concerns disruption in the space will weigh on current players. An index of global software stocks has had its worst start to a trading year since 2022, as fears of further disruption in AI weigh on more established players. As this Bloomberg chart shows, a Morgan Stanley index tracking software stocks is down 15% already in 2026, while the Nasdaq 100 index is flirting with all-time highs. The release of a new AI tool has weighed on sentiment, similar to the sell-off that was sparked at the beginning of 2025 when China's DeepSeek entered the AI arena. Henry Jennings from Marcus Today says the AI sell-off is starting to look like a horror movie.
It's like Friday the 13th, Freddy's out and about and slaughtering the likes of Wistek and Zero, which is starting to live up to its name and has dropped below $100 and heading towards zero in some respects. And it hasn't been good. And it's the same story in the US in terms of software companies. There is a theory, and quite a big theory, and it's certainly taking place in the market, that software companies are under serious pressure from AI. The likes of Salesforce and Adobe, no matter what they roll out in terms of new features, AI is kind of eating their lunch, and there's not enough people adopting the new features that these guys are paid big money to develop. So it is kind of hard at the moment for them to make any headway in the US, and that's flowing through to our market.
So where to look for opportunity amid the current downturn? Well, Claude Walker from A Rich Life says, overall, the disruption we're viewing in AI will allow more competition, and the current downtrend is an opportunity to pick up high-quality names that are trading at a discount.
I think that something like Pro Medicus is not really threatened by the AI thing, because in fact, they're the ones that are best positioned to actually incorporate AI advances onto their platform. They're already doing so. They're miles ahead of anybody else in terms of actually commercializing that kind of technology.
Pro Medicus has fallen almost 16% so far in 2026 and is down around 30% over the past 12 months. And ASX TradeWatch data shows shares in a long-term bearish trend confirmed by multiple indicators, with the 200-day moving average falling, showing that demand for the stock is low. Analysts, though, are upbeat. The average recommendation on the stock a buy, according to Refinitiv, with a price target of $326.49, suggesting shares can rally around 73% from current levels. Technology One is another company analysts favour. Shares, though, also in a long-term bearish trend, suggesting demand for the stock is low. But Alfreda Yonker from Alfinity Asset Management has trimmed her position in Life 360 in favour of Technology One.
For us, we continue to be very excited, particularly around their ability to grow in the UK, what they're doing on the AI side. And I think this recent sort of pullback has given us just another good entry point into a company that we can see multiple levers to grow, high quality, and some really good momentum still continuing to come through in that business. So Technology One would definitely be our preferred pick for 2026.
A lot of analysts agree. The average target price around $35.60, suggesting a 30% rise from current levels.
But I would say we're getting to the point now where this idea that these companies are in trouble has well and truly taken hold, and that is expressing itself in the stock prices generally. So that's why I say now's the time to sharpen your pencil. Look at those tech stocks that are high quality, that you always spent 2 years being like, oh, I'd love to own that great business, but it's just so expensive. Now's the time to start maybe nibbling them.
And the next litmus test for investors will be earnings from some of the global heavyweights. Microsoft and Meta report at the end of January. Google follows at the beginning of February, Amazon reporting on February 5, and Nvidia reporting on the 25th of February. Investors will be closely watching for 2026 commentary on capital spending from hyperscalers, major cloud and technology companies. Revenue growth at leading cloud partners will also be under scrutiny, particularly as markets evaluate returns on large-scale investments in AI data center infrastructure. Alex Pollock is the Chief Investment Officer of Loftus Peak and has been invested in Nvidia since 2016. He doesn't believe there's a bubble and is staying invested for now.
to be in an AI bubble, to be in a bubble, you have to get valuations that are properly stretched. And by definition, almost, you can't be in a bubble if the number of your companies that are part of the bubble are are trading at forward multiples of 20 or 22 or 23 times. Bubbles are when companies are trading at 150 times or 250 times or 350 times. Those things are bubbles. And if you cast your mind back, 20 years ago, there were a number of companies trading with PEs of 150, 250 times, etc. Difficult to get a bubble when valuations are, PE valuations are sort of somewhere below around 30, 35 times, etc. Difficult. Not impossible, but that's not the stuff of bubble territory.
And that is your IG Macro Intelligence. We'll see you next time.